Selfwealth Live, our technical analysis edition, once again with myself, Roger, here from Selfwealth, and we've got Jason McIntosh from Motion Trader. How are you today, Jason?
Hey, Roger, I'm good. All well today. Interesting things going on in these markets. We can get stuck into all that in a minute, and I think a few interesting things to talk about. Hopefully some good codes coming through from the viewers today, because I always enjoy going through that section, like seeing what people are looking at and the ideas that can come from that. So, yeah, hopefully you've got a bit to do today.
For sure. Exactly. It is an interesting time. It's whenever I speak to people, they're once again, they're a little bit on the fence. Some are expecting a crash. Some are just, hopeful that, it's going to stay where it is because everyone, a lot of people's portfolio is running hot at the moment, going well. And then you've got, from our perspective, it's sort of going a bit sideways at the moment. But we'll talk about that very soon. Welcome everybody to our show today. It's fantastic having you here. As you know, or if you don't know, if this is your first time, we will run through our markets, so the Australian market, the US market, and the Hong Kong markets. That's what's offered on the Selfwealth platform. Obviously, this is run through the Selfwealth channel, our YouTube channel, right? So, and then we'll answer any general questions you may have around technical analysis. But please feel free to put through your questions in, and we'll go through that. And then we obviously have a look at your tickers, right? Any tickers that you might want to bring up. We'll look at the charts, we'll look at the price charts, we'll look at how they're structured, and we'll give you a bit of an opinion on what we think around that chart. Obviously, everything is general advice only, so you've got to do your own due diligence and do your own research, and that's why we're going to go straight to our disclaimer now. Thanks, Jason, for you to bring that up.
Okay, and so nicely introduced by Rog, and here it is here, the general advice. So everything, as Rog said, everything today is general commentary only, no personal advice. I'm not part of Selfwealth. I'm from Motion Trader. You'll see information about me in the top section, licensing, etc. And then beneath that is the Selfwealth information. And it's just all about that general advice.
Exactly. And I was talking to my brother yesterday about his ETS portfolio. He's a little less of an active trader than myself, or investor than myself. He loves doing ETFs, and he was going, oh, look, I've never been happy with just investing in ETFs. So even if you're not an active investor, going on the theme that I was talking about, being an ETF or being a sort of more of a passive investor, because we've got a huge amount of people on our platform. They're more passive investors as well, right? It's a good time. It's a good time to be in the markets, but I always said to him, you've got to be prepared a little bit for the downside, and that's what we are fantastic at teaching here, which is great. All right, before we get into it, let's obviously we've done the disclaimer. Let's have a look. I'm just looking at some of the questions and anything here. No, all good. We'll get on to them. Let's start off with that Aussie market and how I feel it's just going a bit sideways at the moment.
Right. Okay. So let's skip over to our charts, and to start with, we have the ASX 200, and so we had a new all-time high about a week and a half ago. And since then, we got an initial quick pullback, and then the last week really has just been tracking sideways, just back towards that 50-day moving average. There's often a tendency, Rog, to worry about market tops in these situations. And you were saying earlier, you got a mix of people that you speak to, some looking for a market crash, and that's always the way. There's always someone looking for things to really turn down, and this is a worry. People worry, when's the top going to be? And every time the ASX 200 has one of these all-time highs and pullbacks, then I think people do worry about, is this going to be a much bigger reversal? Not everyone, of course, but a lot of people. More often than not, though, I think the best course of action is to view these pullbacks as temporary pauses within an ongoing trend. And you just look at this chart here, the ASX 200 over the last year. Well, here's the start of the year. Look at it from the start of the year, and there've been over half a dozen of these pullbacks and consolidations along the way. The longest being this period from April through to June. That went on for about 5 months. Also, the shorter, sharper versions like we saw in August. A lot of fear came in around that period. But the one thing all these periods have in common, or all these pauses have in common, is that they've been temporary. They've been temporary pauses within this ongoing upward trend. Now, of course, every trend is ultimately going to peak. It's not a case of every pullback is just going to quickly be reversed and market goes onwards and upwards. There is ultimately a peak, but no one knows where that's going to be. So I think the odds favour in these situations that the path of least resistance is just staying with the overall trend. And I think the odds favour that the ASX 200 will see new highs before all this is done. So just stepping back a little bit, just considering this overall or this underlying chart structure. And so we've got the ASX 200. It's been rising along these or above these moving averages. So the 50 and the 100-day moving averages, and price is currently above the moving averages, although albeit coming back towards it. And of course, all throughout the year, we've had this series of you can see the lows are progressively rising. This August one made a new low below some of these previous ones. But generally speaking, we've had a series of rising lows, rising highs. And so based on those factors, I think the default position should be to treat this as an ongoing bullish market until we have evidence to the contrary. We don't currently have that. I think what this quick reversal does, I think it tells us is maybe there's more consolidation to come. The fact that it's reversed most of October's rally, so we've had the initial rally through October, it's given most of that back. I think that just says the market's not ready to move higher at the moment, and that maybe we do work on that basis. There's more consolidation to come. I think one scenario would be for consolidation above this support. You can see this horizontal band on the chart that comes in around 8,100. Maybe there's going to be some ongoing consolidation above that support. Coincides with the 50-day moving average. They're pretty typical regions to get consolidation. But as I say, that trend remains up. Having a look at the equal weight. So this is the ASX 200, which is market cap based. Having a look at what the equal weight version is doing, which is always interesting because it ranks the bigger stock the same as it does the smaller stock. So it gives you a good indication of what the underlying market is doing. Now, I think this is interesting because in the last 5 weeks, so from this September low, the equal weight put on about 10%. In just 5 weeks. That's a pretty good size rally when you think that the average yearly gain for the ASX is less than that. So it's done 10% in 5 weeks. So I think given the extent of this move that we saw, when you think about it in those terms, it's not that unusual we're getting a pullback. And also prices got pulled a bit away from the 50-day moving average. And when these things happen, it's just not surprising the market does come back, as it is now, back towards the 50-day moving average. We saw something similar back in January. It was a similar sort of situation. So this is January here. So the market had gone from below the averages. It was about a 14% move on that occasion. Similar sort of time frame. It was a swift move. And then we got a pull back towards the averages with consolidation. Not dissimilar, perhaps, to what we're seeing now. And remember, these consolidations are normal. They occur regularly. There'll be, average year, there'll be multiple 2 to 5% corrections. They happen quite a bit. I always come back to what is the underlying framework. And when we look at this, what we have is we've got rising moving averages, we've got price above moving averages, and that's simply bullish. I'll continue to approach this from the long side, and Rog, as we talk about each week, for me, it's about using wide trailing stops. It's about letting these trends run for as long as they can, but we're always looking at how we manage risk. So it's not just buy and hope for the best. It's let profits run, but a trailing stop is an exit point, a predetermined exit point you set below the market. I like to give stocks lots of room to move around, but ultimately there's a point where you say, okay, enough's enough, take the capital off the table, protect it, and wait for new opportunities. That's what the trailing stop does. It eventually gets you out when conditions change. But at the moment, those conditions, they haven't changed. It's still a bull market.
Yeah, exactly. That's why it's good to have a rest while it's sort of consolidating, going sideways, and sometimes just a good time to do more research and appreciate, because hopefully we will see what happens coming next. But being in a bull market, it's a fantastic time to be in. That's why I said that at the start. Let's have a look at the US market. I'm assuming it's a similar picture, right?
Yeah, fairly similar situation in the US. It's generally been a fairly quiet week for the S&P 500. Prices have pulled back from this all-time high, which was a couple of weeks back. But overall, this upward trend remains in place. It's been in place for some time now. I'll come back to this in a moment. First, what I want to do, I want to talk about about all-time highs. And we're just on that theme with the ASX that people see highs and pullbacks and they get worried and so on. Just to build some perspective around that. So this is the this high in the S&P 500 on Thursday a week and a half ago. That was the 47th all-time high for the year. Now, when you just take that out of context and just say the S&P's made 47 highs for the year, I think a lot of people go, wow, that seems like it's quite a bit. That sounds worrying. Maybe it's gone too far. It's actually not as extreme as you think it may be, because the most all-time highs the S&P has ever made in a year, it was 75. So at the moment we're at 47 and the record is 75. So to beat the record, there's a lot further to go. Not to say that record's about to be broken this year, but putting it in perspective. That was back in 1995. And then you might wonder, well, okay, look, surely after 75 all-time highs, the next year must have been a down year. But that's not what happened. The next year there were 39 all-time highs, and the year after that there were 45 all-time highs. And then this sequence continued for several more years. I'll show you what that looks like. This is something I shared on my weekly strategy sessions on Friday to viewers of that. I think it's interesting to have a look at. So what I'm going to do, we're going to go back in time from current day. We're going to head back to this previous period in the 1990s. So just bear with me while we go back through time and scroll back. And this is where I want to get to. So here's our record year, 75 all-time highs. And of course, as we went through, people will be thinking, well, when's this going to end? And here's our next year. There's our 39, and then there's our 45, and the game continues. It continued on for another couple of years until peaking around 2000. And this is the thing. This is the thing with all-time highs. We get clusters of them, and that's how trends work. And a series of all-time highs, a series of all-time highs isn't warning of a top. It's telling us the market is an uptrend. So of course, every trend is ultimately going to end. We don't know where that's going to be. It could have ended much earlier, but it didn't. So we don't know where the end's going to be. And the thing is, there's going to be corrections, and there's going to be pullbacks along the way. And you can see on the way up, look at all these pullbacks along the way. And some of these are quite notable. Like, you look at this one here in 1996, came back, steep decline below the moving averages, scary, unpleasant, but the trend remained intact. The moving averages never turned to the downside. So this is one of these things that I think we need to be aware of. And so what I think the data tells us, when we look back through history, we'll look at the history of all-time highs. It tells us that all-time highs is just pointing out the path of least resistances to the upside. Going back to current day, what we have at the moment, looking at this chart structure, we've got those rising moving averages and prices above those moving averages. And we've got the higher highs, we've got the higher lows. By definition, that's what we call a bullish price action. We don't know how long it's going to last, but the benefit of the doubt goes to the incumbent trend, which is currently up. We've seen this pullback from the all-time high. I think there's certainly scope for several weeks of consolidation. And look, there's nothing to say that the market can't pull back towards that 50-day moving average. But at this stage, nothing here suggests that we should change the game plan, in my view, from being long equities.
I love the ability of you being able to analyze history that way, Jason. And just to confirm to viewers or people that like we don't know what's going to happen in the future, but being at the top doesn't mean it's going to crash, right? Yes, I mean eventually something's going to come down, right? But I love the ability for you to analyze multiple sections or decades and years and just say, hey, we're not even close to the year that's had the most all-time highs. And part of my curious brain wants to know why we're in this situation, which is so bullish now. Why back 20 years ago was that? I think maybe it was to do with the IT boom, maybe, right? So part of that curious brain of me wants to do that and wants to know all these things, like a lot of people want to reason and understand why. And then I think back to my earlier mentors and why I love technical analysis so much is that he always used to say, look, it doesn't matter what happened. Who cares what happens? Because knowing what happens, like many market analysts want to explain or predict, knowing that generally doesn't make you money. Being able to read the charts the way you do makes you money, right? Forget about the news story behind it. Just be able to read the charts and do some analysis around it. That's what makes you money, right, in the market. So I always go back to that. As much as my curious brain wants to find out and learn all this sort of stuff, I just go back to loving the way you analyze these charts, Jason. I'm glad you're doing it. So it's fantastic.
Oh, that's good. Thanks, Rog. It's for me, the why is not so important. I'm not really so bothered about why. It's like I want to understand how a process works. But why the market is rising, it's not such a big deal because I understand my process. My process is when the market's working, let it keep working. Don't worry about why it's working, but it is working. So my process involves letting profits run. And it also involves having a strategy for managing risk when it does ultimately peak. It's like I showed you that section from the 1990s. So that's not to say that what we're seeing now is going to continue in the same way the trend from the 1990s continued, which went on for another 4 or 5 years, whatever it may have been. This one could end this week, and the market could crash next month. We don't know. And no one knew that in the 1990s either. No one knew that trend was going to last another half a decade. But you don't need to know. All you need to do, I think, is you've got to have that process that can take advantage of periods where prices are rising and a process that helps you stay on board for as long as possible and then gets you out when conditions do invariably change. There will be another market crash. You can almost be certain about that. Just none of us know when that's going to be. You can go to the doom channels and they'll tell you it's going to be next week, but they've been saying it's going to be next week for the last 30 years I've been in the market. That's just how that section operates. We don't know. No one knows. I don't know how long this bull market will last, but I'll make the most of it while it's there. And those risk management strategies, I think, are critical to protect capital when the situation changes at some point. But yeah, as I say, for me, let profits run, give the market room to move around, because we saw in that section from the 1990s, there were some scary pullbacks, but nothing which really broke down that upward trend. And just like we had in August. August is not that far from people's minds still. We remember that scary sell-off. People thought, oh, look, is this it? But then the market was back at new all-time highs within a few weeks. So you've got to give markets room to move. But the default position should be, if there's an upward trend in place, long is the default setting.
Yeah. All right. Well, let's have a look at Hong Kong then. That's definitely consolidating still.
Yeah, consolidating. I think it's encouraging the way it's consolidating because prices now do seem to have stabilized. And so far, they are holding on to most of the gains. So looking at the gains from the September low, the strong rally, had that sharp pullback, but now it has very much stabilized and most of those gains are intact. And this is what we want to see in an emerging trend, that the market can hold on to its previous gains. And we want to see the dips being supported, which this is now seems to be the case. I still think this could take a bit more time to play out. Maybe moving sideways as the moving averages continue to catch up. But at this stage, I think the signs are there that this could be part of a larger trend change. Big declining phase, and now it looks like maybe this is it. Maybe this is part of a larger turn higher. Having a look at the Chinese market, it's much of the same reasoning goes there. We saw that sharp rally, had an equally sharp pullback, but now we've got that stability coming in. The stability's come in above the 50-day moving average. So it now looks like there's buying interest starting to come in and just underpin prices. Like Hong Kong, I think, or the Hang Seng, I think it probably needs a bit more time. But for anyone who's interested in establishing a position, this seems like it could be a reasonable level to consider that. And the same goes with the Hang Seng as well. So if we look at this and we think, look, is this large downtrend from 2021? Has it bottomed? Is this the start of an emerging trend? It does seem like it's an asymmetric way to start looking at it, because like you think, well, if someone was to establish a position at current levels, so we're going into the momentum, we've got the upside momentum. We didn't want to play at the top because it looked like it was a FOMO period. It got so stretched above these moving averages. We've now got that pullback. So this is, for people who like buying dips, I think this is now the dip, because it's dipped back towards moving averages, which are now heading higher. So this is the sort of dip I consider. And you think, look, how do you manage risk around this? And if I just measure this out from current levels, could have a stop back below the 100-day moving average, and that's about 10%. That seems reasonable when we consider the upside. So we measure this from the upside perspective, and say the market were to get back to its previous highs and maybe beyond, that's say 50%. So we don't know what the upside will be, but we say, look, 50%, it could happen. 10% of downsides. So that's a 5-to-1 ratio. That's what I call asymmetric. So it doesn't mean you're going to get that. But I think if you play situations where you can see there's potential there for 3-to-1, 4-to-1, 5-to-1 or more, I think that's putting the odds in your favor over time that you get those big payouts for relatively small risk. You don't have to be right all the time to make money. You can be wrong. You can be wrong half the time. And if you're playing with the mass in your favor like that, 3-to-1, 4-to-1, etc., you come out in front over time. So I think this is a situation which people could start considering. Let's see how this price action plays out. But for those who want to buy the dip early, it's I think this is a potential entry point.
Fantastic. And obviously on the to be able to get onto these kind of things at the moment, are you still looking at from a stock perspective, or more maybe getting onto an index or something, Jason?
Look, I'm not looking at the individual stocks. If someone's got the capability of looking for individual stocks in these markets, particularly the Hong Kong exchange, which you can trade through Selfwealth, if you know your Hong Kong stocks and you can look at moving averages and you can interpret a chart, by all means, if you see the right opportunities. For most people, it's probably an ETF. That's probably the way I'd play this if I was. And I actually do have emerging Asia exposure, and that's done through an ETF. I've had that for a bit, and so I think for most people, ETFs are probably the simplest way. And you just do a search, do an online search, ASX ETFs, or of course you can do the US stocks through Selfwealth. So you could look at the what the US offerings are, but you probably find what you need with a local stock. And that's what I do. China ETF ASX, or ASX China ETF, some combination like that, and I think you should get several options.
Yeah, I'm sure you can certainly find some ETFs in there. I think from last count there was about around 350 ETFs that Australia, the ASX, has on board, right? So there's quite a few offerings there. All right, so let's have a look at some of the no real general questions. So let's plenty of tickets though. So let's start with these. I mean, obviously. I know we have a one statement here saying that if Trump gets in, we will have another 4 years of bliss, of economic bliss there, Jason. So there's a bit of fundamental news for you. Let's all vote for Trump there.
It's interesting. That seems to be the expectation. Like, I'm always happy for periods when the stock market's going to run, but yeah, I always do wonder though when there seems to be a general consensus. I always wonder about the other side of the consensus. It's like, I don't know. It's not. I don't know. I'm just following the trends. But if too many people start saying if this happens, then this will happen, it's like it does bring on a little bit of concern because there's nothing certain in this game, and Trump doesn't control the stock market.
No, I won't be voting for him. That's for sure. Well, I won't because I'm an Australian. But all right. I wish I could vote for anyone else, but we can't. So let's have a look at some of the tickets. Anyway, SVR to start off with, please, Kirby.
So this is a motion trader stock, and I've actually got some of this myself. The signal must have been around August. You can see it's gone from being, just go back to where it's come from. It's been down and out for years, like peaked back in 21, and you didn't want to know about this stock through 22, 23. Look, probably from looks like we've got this sort of basing. Looks like you can say there's a bit of a rounding basing sort of structure in place from say the latter half of last year, where you get this series of lower lows, starts the downward momentum dissipates, and we start getting rising lows. So that's an encouraging sign when you see that after a stock's been in a lengthy downtrend. Gone from below the averages to above the averages, have crossed, broken to a new high. That's triggered a motion trader signal. I've got in sometime around there myself. It's trading. It hasn't really gotten away to the upside as yet. It's got that potential of a building trend. So we never know. We never know which setups are going to deliver, but it's certainly got the potential to continue to move higher and potentially significantly higher. We've got this series of rising lows. We've got the rising moving averages. Prices have recently pulled back to the 50-day moving average and rallied off it. Whether it's just traveling sideways at the moment, potentially, maybe we get more consolidation sideways prior to a breakout. That would be one of the positive scenarios. But as I say, I'm in this. It's in my portfolio at the moment. I'm not looking too closely at it every day or anything, but I'm happy to just have it sit there in the portfolio whilst in this position. If it starts to starts breaking down below the October 22 low, back below the 50 and the 100-day averages, well then it could become one which I'd then look to move on quite quickly. But at this point, I'm happy in there. It's probably also like anyone without a position who was interested, whilst it's in this sideways period, it's a possible entry point. And again, you can know where the risk is. You can have a set a stop, which is say maybe 15% below current levels, and say symmetric because 15% of potential risk. It's one of those stocks which could double and beyond. So it's risk. It has a good risk reward payout. Just have to see whether this is one of the setups that actually delivers.
Yeah, I like those setups, especially when it starts consolidating, bounces off the EMA once again, and then starts moving up, and you can easily sort of manage risk and calculate where you want to put that stop loss, right? So it's a good one there. All right, so let's go on.
And you just imagine if you have a portfolio of 20 stocks that look like this, half of them can just fizzle out and not do much. a quarter of them might do okay, and then the other quarter, or maybe 20% of them, goes gangbusters. And that's all you need. You don't need everyone to deliver, but you get a portfolio of positive setups. You just need a portion of them to really get going, and it can really make a portfolio. The key is you're protecting the risk on the ones that don't play out. The mistake a lot of people make is they don't sell them when they stop working, and they hold on, and they can get stuck with stocks which are down 50, 60, 70%, and some of them even double up on the way down. The whole thing just snowballs into a calamity. So just always protecting that risk, but playing positive setups, and lots of them. And as I say, you only need a few, and that can really set things on for your portfolio.
Yeah, I mean, everything you said there is like, I think it's, once again, it's spot on, right? Like, I think, I mean, at last count, because I've just done my taxes right, but I had to report, I think it was like 26 positions that I'd closed out, of which would have been about 20, maybe 20, 23 that were in the negative, closed out in the negative, so sold off, right? But overall, to this day, that portfolio that I'm using based on these strategies and simple strategies is up around 40%. If I was to close out everything right now, I'd be up 40% over that period of a year and a half, right? So that I started this portfolio. So even though I've had a lot of, like, that would seem like a lot of hits for people, right? 22 or 23 losses out of 26, right? So which I had to report, and then, but still to this day, if I closed out everything now, I'd be up 40%, right? So so it's a good feeling to have, right? So we're on the right track, Jason. Thank you. That's all I'm going to say. So now the next one from Michael is saying, I've got these ASX stocks that I'm already holding. Could you please have a look at their general chart structure? I'll continue on with the comment afterwards, and we'll have a look at the tickers. They have this gradual sliding down from the top. How would you manage risk with these? I'm not sure if they are rounding tops for start of a major trend change or just normal drawdowns. Thank you. All right, so we'll start with EZZ. This is a good one. Obviously, we saw I closed this one out too early. I remember this one.
At this stage, we don't know. At this stage, I'd be giving it the benefit of the doubt and saying it's a pullback. We've still got those rising moving averages. Prices only come back to the 50-day moving average. So there's every chance that this consolidates and it could continue moving higher. We always need to bear in mind that it has had a huge run. It's gone from 50 cents up to $5. So that's it's a tenfold run, and it's within the space of a year. So like, who knows how much further it can run? But they're generally stocks typically don't go up 100-fold in a couple of years. Or anything can happen, but we just bear in mind that it has had a big move. But just looking at the current structure as it currently stands, it's the uptrend's in place, and I'd be giving this a pullback, calling this a pullback, and I'd be using the wide trailing stop. Now, the wide trailing stop is going to give back. Like the way I do the trailing stop, the motion trader stop, it's volatility based, and like look at the size of some of these daily ranges. It's bigger than the whole share price back in April. So the trailing stop I'd be using would be below the 100-day moving average, and someone might say, look, that's a lot to give back. But then you ask, well, how did we get in this position in the first place? So I think the motion trader entry signal would have been back here in around April at around 82 cents. So how have we gone from 82 cents to $5? Well, we've given it lots of room to move. Look at this period here in June or in July. So that was about 30%. Doesn't look like much on this scale because it's continued up so much, but that's a 30% pullback. The only way that could be survived was to have a wide trailing stop, which is often below this 100-day moving average. So yes, wide trailing stops give back a decent portion at the end, but they also can keep you in. So if you want to go from 80 cents to maybe $5, You got to see off these intervening pullbacks. Is this another one that resolves into the upside ultimately? I don't know, but I'd be giving it the benefit of the doubt, and I'd be willing to give back a decent chunk of profit to find out. And if I was in early enough in the trend, I'm still going to be so much in front that if I give back towards the end, that's just the price of admission to the game of trying to stay on these big medium-term trends.
Yeah, exactly. And I think this is one I was talking to you about a few weeks ago, where I got in well under $1 on this one here, but I got out way too early at that pullback back in July of last year, I think it was, or July this year, whatever we look at that pullback, and it just tipped me out, right? Unfortunately, I stuck to my rules, and I got out, just at that pullback there, and I could have got a lot more. At that point, I've also increased my ATR stop there to account for that, because I had a less than what you were using at that point, Jason. So, but as you say, just a few of these are the ones that are in my portfolio that are carrying it to where it needs to go, right? You only need a few of these, right? So, all right. Well, let's.
And if you look at this, look at this period in July, if we're looking at, if this is where we are now, that's a pretty unpleasant sell-off to sit through. You've got in below $1. You've seen it run up to 240, and now it's back at $1.73, and you're worried that the next step is back down to $1.20, and you're going to get back all your profits. So this is the way people think, and I'll be concerned about that too. But I'll have a trailing stop in place. Sometimes your trailing stop gets nicked and it goes on to a new high. Well, so be it. It's not like a magic point which keeps you in all the time. We don't know. We don't know exactly where to place, but we can use back testing and data to work out levels that have historically been suitable to staying on medium-term trends. And so then look at this period, and then you compare that to where we are now. It's not dissimilar. It's not to say it's going to work out the same, but it could work out the same. So that's why I'd say I'd give it the benefit of the doubt. Nothing wrong with scaling out of positions also. If you find yourself with a 500% gain, it could be a 300% gain or 200% or whatever it may be. If you find yourself with a chunky triple-digit gain, there's nothing wrong with scaling out of a position, particularly if it helps you sleep better at night. Maybe you'd sell 20% or a third or a quarter, whatever it may be. Whatever portion works for you, sell half. But I'd want to be keeping some money on the table, because you just never know. You don't want to jump off what could be the year's best trend prematurely and unnecessarily without like a really good reason to get off entirely. So that's why I'd say I'd want to keep a foot on this one, in case it fires up again, and next stop is who knows. So yeah, that's why I'd play it.
Okay, SRV, please.
At the moment, this is a routine pullback. There's nothing here to say that there's a top happening here. Just like we were talking about with the ASX 200 earlier, there's going to be multitude of pullbacks along the way. But I look at this chart. This is like anyone who wants to buy the dip. This is a potential dip to buy. This was interesting. A sharp sell-off, came straight back. Now consolidating along the rising 50-day moving average. Look, a break below the September, the 22nd of September low at around $4.70, maybe that, and that gets below the 100-day moving average. Maybe then you'd start thinking, well, is a larger turn in place? But at this point, I'd be sticking with this stock, and I'd consider buying this dip, because I know where I can manage my risk to, and I know there's plenty of upside potential beyond. Let's quickly jump to weekly. What's the history on this one? There's a big head and shoulders bottom. There's your shoulder. There's the head. There's the shoulder. You draw a neckline through there, and it's had this big initial run. It also wouldn't be unusual to see a stock like this consolidate. let the weekly moving averages catch up a bit. So doesn't need to run week in, week out. But at this point, the underlying trend is mainly to the upside.
All right, SXE.
Sorry, what was that, Rog?
SXE. A bit of feedback.
This one is more potential for like, is this a rounding sort of topping formation happening? Like we did a rounding base before. You can also do a rounding top, in that you've got higher highs, you get a peak, and now we've got declining highs. The moving averages are starting to turn lower. Shares have gone from above the moving averages to below. They're currently rebounding. This situation could still stabilize and turn back up, but I think there's more risk with this one that could there be a top forming? There certainly could. If this was in my portfolio, I'd still keep it there, because my trailing stop is probably still below the October low. But I think a break below the October low, it really then we start to get this sequence of lower lows, and would also then have a situation where, like, if we get price action which starts to look like this, so then we've got a falling price with the moving averages turning lower, and that's when I get worried about a trend change, and that the path of least resistance has swung the other way. It hasn't happened yet, but it is a stock which is becoming vulnerable. There's also we can also say there's some overhead resistance. So you can see resistance coming in around $1.75. These previous low points also corresponds with the moving averages. So has this changed from buy the dip to sell the rally? I certainly wouldn't be buying this one, and I'd be watching closely if I held it to see whether or not I want to be hitting the eject on it. Wouldn't jump out just yet, but I'd be getting pretty close.
All right, TWR.
Still an uptrend in place. Pull back to the 50-day moving average. So I've got to give pullbacks to the 50-day moving average the benefit of the doubt. There's not enough here to say there's a top in place. It's had a big move from 50 cents to up towards $1.30. So it's up 150 something percent from its low point. So it's normal that it should pause and consolidate. I'd be watching this. If it was in my portfolio, I'd be holding it. My trailing stop would be below the 100-day moving average. See what's going to happen. If you're using wide stops, you're going to give back. You're going to give back moves like we've seen so far, and you'll give back more as well. If you're trying to avoid giving back the sort of move we've seen so far, then it's just not going to be possible to stay on medium-term trends, because you're going to get pullbacks of 20 to 30% at some points. This is only what's this is probably only like 10 or so percent. It's 15%. It's a modest. I'd describe this at the moment as a modest pullback. Moderate pullback is probably 20% plus. But it's just back to the moving averages. So I think trend is still up.
All right. The other Roger asks, what's your view on GTK?
Now, I've got this one. I've had it for a while. It's been one of my best performers. A bit like what we're discussing with Southern Cross, SXE. It's gone from above the moving averages to below. It doesn't have the same rounding topping formation as SXE, as we went through before. I think the technical structure of GTK is better. Nonetheless, once a stock can have some excursions below the moving averages where it doesn't spend too much time and heads back up. We see that a bit. So just dropping below the 100-day moving average on its own doesn't say, okay, it's all over for this stock. It means we want to keep an eye on it. But let's see how much time it spends below here. It could be back up above there in the next several weeks. What would worry me if it does start to stall and just travel sideways below the moving averages while the moving averages start to turn lower. and then from there, from sideways, then it starts to break down. That's when I start saying, look, I think a top's in place for this one. And it would be a case of like, where's the trailing stop? Where's my exit point? But at the moment, it's in my portfolio. It's still in the portfolio. I'm not looking to exit at the moment, but I'll keep an eye on it. It's been a terrific trend. It's up for where my entry point is. I was in at about 220 or something. So what's that for me? It's about a 250% gain. The motion trader initial entry point was back down here in November 22. That's a 540% gain thereabouts. So, these are real gains that people have because they followed breakouts, they followed signals, they've used wide trailing stops, and they've ridden this trend. So, there are people with motion trader who are up 500% in this stock. So, results like this are entirely achievable, but it's following a process. It's buying the right type of setup and giving it room to move and letting the profit run. And it does happen. It certainly can happen.
All right. Let's have a look at WAM, please.
Not much here for me. It's in a big range. It's you can see like it's a narrowing range too. You can see the lows getting a little bit higher and the highs are getting lower. It looks like these are dividend payments, which I'm guessing they're dividend payments because they seem quite regular. What we can do, we can hit the adjust button. That will put the dividends in because I think this is actually a managed fund. I don't think it's the actual fund manager. I'm not sure though. When we put the dividends back in, it changes the picture quite a bit, doesn't it? There's a rising low. So it's generally been. Looks like it's been generally doing okay when you put those dividends in. It's got higher highs. Someone was holding this as. I'm not sure whether this is an LIC or whether this is shares in the actual fund manager. I'm guessing it's like a listed investment company type of situation. In which case it's continuing to grind higher. It's not one I get particularly excited about. But if it's part of someone's portfolio, it's when you include the dividends, maybe it's maybe it's a hold. This is certainly not a reason to sell it, from what I can see on the chart, except for if someone decided like they had another use for the capital. But at this point, there's no problem. I don't think with hanging on to it.
All right, fantastic. Let's have a look at MME now, please.
What was that code again?
MME, double M and then E.
Yeah, this is one of those stocks which you never know. It's got the setup's positive, and that has gone from below the averages to above the averages have crossed. Had an initial run. You got that classic sideways move back to the moving averages. Started to have another breakout in the last week or so, just pulling back from that. A couple of, like if I was in this from a little bit earlier, I'd be happy to hang on to it. I think stop loss could be below the 100-day moving average. It could be bought at current levels. Stop loss, well, it's a decent stop loss. It's like, and also remember this is a 12-cent stock. So I think I'd want to be giving this. Say, it's coming up to 30%, probably a touch under 30%. So below the 100-day moving average. I'm also looking at these lows from August or from September, just going a touch below there as well. So if it's bought at current levels, I think it's about a 30% stop loss. But that's getting towards the largest of the sort of stop losses I'd be considering. But it's asymmetric in that you look at like it's a 12-cent stock. It could double, and then it could double again. So it's very much has that upside skew to its potential. Or another way to play it would be buy a breakout to a new high. So the highs looks like it's 15, maybe buying it at 16, and then you say, look, if I bought at 16, I could have a stop loss maybe back towards the 50-day. Again, it's about 30%, but it's got that real skew to the upside potential. So I'd say it's a highly speculative stock, but some of these ones can pay off big time. So certainly one to consider for those who like that area of the market.
All right, MFG.
Yeah, this continues to show signs of an emerging trend. Got this large head and shoulders bottom. Got the shoulder. Got the head. Got another shoulder. Do seem to be starting to get this sequence of rising lows, rising highs. It's signs of an emerging trend. I wouldn't say this is an uptrend at this point, but it's certainly an emerging trend. It has the potential to continue into a larger trend. Does it consolidate for a few weeks sideways while these moving averages catch up? That's one possibility. Someone could say, look, I want to buy the dip now, and I'll have a stop below the 100-day moving average, which is, I'll put a 15% stop on it. Or they might see if it consolidates. If it consolidates, buy the dip a little bit later, or buy a potential breakout. Like, you look at where it's come from. It's come from great heights. It's down and out. Can it stage a good recovery? Certainly could. Could it double? Certainly could. When we're talking 15% of risk, potential for the doubling, it's a play to consider for part of a portfolio.
All right, SQ2.
So this is the old, what was it? Afterpay. Afterpay was bought by Block. So Block is a US-based company, but they've taken on the listing, the old Afterpay. Look, it's got that look of a head and shoulders bottom too. Like, you can see the left shoulder over here. You got a head, the right shoulder, and it's got that. Not a whole lot of data on it because it only goes back to February 22. It's not my favourite of chart structures because I just don't have enough data on it. But it does look like it's got the similar to MFG in that it's got the structure for an emerging trend. It looks like we've got some rising lows, moving averages have crossed. It's just broken up to a new recovery high for the last few months. Let me see. There's probably a US listing which will give us a whole lot more data. Let's have a look at this. Yeah, it's quite similar to MFG. So they're completely unrelated stocks. Magellan Financial Group is a fund manager, and this is something in the Afterpay world. But it's the same sort of structure. It's fallen from great heights. We've got this possible basing structure. This isn't as advanced as the one for MFG, but nonetheless it's got that potential basing structure. Look, I think I prefer looking at this chart just because you've got the depth of data, and the local listing will do basically what the US listing does, but adjusted for exchange rate. I think there's a play here. Look at current levels. A stop could be, say, about 15% lower, just maybe below the October low, which is also below the 100-day moving average. So we're playing this series of rising lows and rising highs, and saying, look, if that sequence continues, maybe it could pause for a week or two or three while the moving averages move up, and then another breakout to the upside. That could be another entry point. But yeah, I think there's something to look at, something to consider with Block.
All right, IVV.
So S&P 500 ETF, and well, it's basically go back to what I was saying on the S&P 500. I think we've got an upward trend in place. There's no sign of an immediate top. You can see this is outperforming the S&P 500. Like, this is an all-time high now, whereas the S&P 500 was a week and a half ago, and the reason for that is exchange rate. The Aussie dollar's been coming off. So there's also a hedged version of this. It's IHVV. That's you're then taking a view on what's the Aussie dollar going to do. If you think the Aussie dollar is going to rise, well, you use the IHVV. If you think the Aussie dollar is going to fall, or maybe you just don't know, maybe you go IVV. But yeah, look, trend in this remains up. It's certainly a hold for any portfolio.
All right, fantastic. Let's have a look at SYA.
Yeah, I was looking at this last week, and I was looking at this last week as a potential turnaround stock. I've been watching those lithium and rare earth stocks. Now, it looks to be the possibility there's some sort of a turn happening in those. And so Sayonara, it's gone from look at the capital destruction of this stock. This is why we use trailing stops, why we manage risk. You can bet there's someone who was holding it at the 22 high who's still holding it now, waiting for the recovery. It happens all the time. But this sort of decline is entirely avoidable if you have a risk management strategy where you say, look, line in the sand, enough's enough. It's not working. I've got to protect capital. I love the stock, but it's not working. I've got to get out. I'll come back and look at it another time if things change. I think you've got to be able to have a strategy protecting capital, unless you're comfortable with being down 95% sometimes. And I'm not comfortable with that, so I use an exit strategy. Looking at it now, though, we've gone from below the averages to above. The averages are starting to turn higher. Haven't turned and crossed yet. If I was to use like a 10 and 20-day moving average setup, you would have found they've already crossed and the price is now consolidating. Look, let's just do that. I use 50 and 100 because it's less sensitive. And if I use 10 and 20, I'd be getting so many more signals. There'd be so much more noise. I don't have the focus for it. But sometimes if I'm looking at a situation where I'm trying to get a turn, I might look at 10 and 20-day averages. You can see they've crossed, prices rallied. Now prices rallied back into the shorter-term averages. And it's like, is this the start of some sort of move higher? Let me go back to the averages, which I prefer. So look, I think how do you manage risk? I was thinking, do I want to buy this stock? And I thought, no, I don't want to buy it yet. I want to see how this consolidation plays out, and then I can buy a breakout, and that hasn't happened yet. So that's the way I'm looking at this. It's such a down and out stock. It's this could just be another rebound like we've seen previously, which doesn't go anywhere. So I haven't preempted a turn in this one, but if I don't want to buy it at this point. I'd rather watch the consolidation, and if it breaks above these recent highs, then maybe I could get a position at 4 cents and put a stop below the 100-day moving average. Maybe it's 25 cents, 25%. So being able to use a 25% stop on a 3.5 cent stock as a speculative position, I think is high risk or high potential reward for the risk. So it's one to keep an eye on for someone who likes really speculative plays. It could be one. Most of these don't play out, but you only need one or two to play out, where it goes from 3 cents to $3, and 80% of these high spec plays can fail. I don't think it's quite there yet. One to watch.
All right, SXE.
I think we just looked at. Yeah, we've looked.
We did. Sorry, we did. Yeah, we looked at that one. Well, let's go to SVM then.
SVM.
Yep.
US-based stock, SVM. Oh no. Here it is. Here, Sovereign Metals.
Yep.
Yeah, look, I like the structure here. Big run, long, lengthy. It's actually like, it's big. It's a big rounding shape as well. So you can see the lower lows, the downward momentum dissipates. Now we've got rising lows. Good rally over from April through to July, and then we've got this sideways move into the moving averages. Looks like it's close to looks like it's readying to break higher again. It's a stock I'd continue holding, and it could even be bought at current levels with a stop loss. Below the 100-day moving average, say 17%. It's I think there's some potential in this stock. Asymmetric in its appearance. Whether it delivers, we don't know, but yeah, I like the overall structure.
All right, SVL.
Not at the moment. Moving averages are still down. Maybe it's starting to turn. It's silver's been doing quite well lately, and this stock hasn't been running with silver. And we've also got this resistance point. You can see these previous lows. It's just run into resistance, start to come back. If it breaks above that recent high. So moving averages are turning. So if it does consolidate at current levels and then breaks above, gets up to about maybe 15, starts to break through this level, then maybe it comes into play. At the moment, I'm not quite ready for this one. It's makes me wonder, like silver's been doing, as I say, it's been doing well. A lot of silver stocks have been doing well. Looking at a silver ETF, silver stock ETF, there's been some upward momentum in the silver stocks. This one hasn't really played. So why is it not playing? So I'd want to see this one breaking out above some resistance.
All right, ACF.
ACF?
Yep.
Yeah. Like this was a stock which I had myself, and I sold it as it was when it was breaking down. It's now stabilized. It's come back to the averages. It could get going again. I'm probably a little bit neutral on it just at the moment. I'd like to probably see it break a bit higher, get those moving averages to cross again. It's had a big run over the last few years. It's not one I'd say I'm neutral on this one for the moment. I'd just like to see this price action played out more. If I had if I was still holding it, well, I'd probably continue holding it, see whether there's some more upside. But it could be, like it's often the case when we get stocks which have big runs, they then often go into these lengthy consolidations where they're just back and forth. It could be in a process of being in a big back and forth environment where it just doesn't do much for the moment. So that's why I'm not that enthusiastic just here.
Okay. SMI.
SMI, I don't know what's happened down here. I don't know whether that's real price action or whether, someone would need to tell us whether there's been some news out of the company and the share price has just collapsed, or whether I've got a data misprint. I don't know, because that's a big change from 70 cents down to 23 cents. So I don't know. I don't know whether this one's been a crash or whether I've got bad data.
Yeah, it's hard to manage that, isn't it?
And sometimes the stuff can happen, but that's some pretty big stuff to happen from a stock that was just hitting all-time highs. So yeah, we just need some clarification on what's going on before we can really get into that.
All right, let's have a look at was there a key reversal candle for XEW yesterday? Equal weight.
Yeah, no.
Okay.
No, not really. I don't think it's just a. Look, it opened, it sold down, and then it came back to near where it where it opened. So it's I like it in general, in that the market tried to sell off and then came straight back. But I don't think you'd really call that a key reversal, which says the market's about to start rallying again. I'd go back to the comments I made on the ASX 200, which looks like maybe there's scope for more consolidation rather than looking for a reversal to the upside just yet. I think for this, more consolidation above the moving averages.
Okay, fantastic. In terms of China ETFs, Rose, like if you're on the Selfwealth platform, if you just type in China in the search bar, you'll find there's a couple there, a few from Van Eck, so do your own research. But Talwin's also given you some tickers you can have a look at there as well, so thanks for that, Talwin. Do you use the same rules for trading ETFs as you do individual stocks, Jason?
Same principles. I don't use the same trailing stop, because ETFs are often, ETFs are based on so many different things. There can be a currency ETF or a stock index ETF or a bond fund ETF. So they're all, I think how you manage the trailing stop can sometimes be different. So I tend to give stocks 25 to 30%, even more sometimes, to move around, but I wouldn't do that for a stock index. I don't need to give a stock index 30% to move around, because if it comes back 30%, it's been in a bear market, and probably for some time. But the same principles go. I want to trade ETFs which are above rising moving averages. I want to let profits run, and I want to consider where my exit point's going to be. If sometimes an ETF can be like, I'm approaching individual shares from a medium-term perspective. I'm looking for uptrends over, say, 1 to 3 years, but I might have a core ETF holding which I could hold for several years, just because it's a longer-term investment. I think an ETF is often different to an individual stock. You might have an ASX 200 ETF that you hold for 20 years. I don't think there's an individual stock I'd be comfortable holding for 20 years, because individual stocks can do all sorts of things. But the ASX 200 as an index is a collection of stocks, and we assume it will be there in 20 years. I'd never make that assumption on an individual stock. So same principles, rules can be a bit different.
Good point. I always recommend with ETFs, just go out and look at the product page and make sure you know what that ETF is constructed of and has all the fees and everything, rather than just relying on a platform as well. So just make sure go to the actual product provider. So for instance, Van Eck is the product provider, Vanguard, Beta Shares, they all have their own, they're all providers of ETFs. Make sure you go to those pages and not just on the platforms, right? Information on the platforms. XCU, no. Let's have a look at CCP, please.
Maybe. It's given us some false breaks, this stock. It looks like we had a false break higher in mid last year. It looks like we might have had another false break higher early this year. But this is the thing: you can get 3 false breaks, and then the fourth break it really runs. So you can't discount a stock because it's been disappointing in the past. The structure's starting to emerge in this, in that the moving averages have turned higher. Prices generally have some rising lows coming in. It's not a standout structure at this stage, but I could see this. It's got the potential to emerge into a rising trend. It's certainly not trending lower, so there's upside possibility with it. And again, risk is managed, like buying at current levels, and risk managed below the 100-day moving average. So it's a relatively tight stop versus good upside potential should it go. So look, as a stock to consider.
All right, 360.
This has been trending high for some time, this one, and the trend remains up. I'd be quite simply letting this trend run. It's been in the Motion Trader portfolio for quite a while now. Not quite sure when. It might be, maybe it was mid last year, because I know it's up several 100%. We've got this. This looks like a corrective consolidation at the moment. We've got an impulsive rally, and we've got a sideways overlapping move. That's telltale consolidation. Looks like it's going to make a new high, but it is getting. If it does make a new high in the near term, then it does start to pull away from these moving averages. So it's probably not one I'd be moving to buy, moving on to buy, but it's certainly one I'd be letting run if it was in my portfolio.
All right, fantastic. Let's have a look at RDN.
Not really doing much here. We're in this sideways. You can see the contracting range. You've got the lows, and then above we've got the highs. So I'd just leave it alone at the moment. If I wouldn't, it wouldn't be in my portfolio. So I probably shouldn't say, look, if I had it, it just wouldn't be there, because I would have been, if I had it, I would have been buying it on strength, and it hasn't done anything, so I would have sold it by now, because it's not doing anything, and it'd probably be below my entry point. Unless, of course, I got in, way down here at 1 cent, which I wouldn't have done either, because I wouldn't have been trading it. Look, I think the key here is, does it break out of the range? If it breaks out to the top side of the range, well, that's all great. If someone really liked the fundamental story, I guess it could be like how do you manage risk with it? Like, I couldn't even do that. So couldn't even say, look, I'd buy it here and put a stop below these previous lows, because I'm looking at 40 to 50%. So for me, it's too hard to manage risk around this one. I'd have to leave this one alone.
All right. I've got a feeling you're probably going to say the same for the next one, which is my fundamental story and why I'm here. But let's have a look at SWF.
Yeah, and unfortunately, I've got to say the same thing. We just got this this downtrend. I really need to see the share price stabilize and start to get back above these moving averages. That's the key to a turnaround. For any stock that's going to turn around, it's going to move back above their moving averages. You can't have a turnaround without being above the moving averages. So for now, it's on the it's not on the buy list until we get that stabilization occur.
Thanks for that. But just remember, you're still getting a $9.50 fixed flat free trade, right? So through the simple to use and platform that we have. All right. They've just talked about SMI going through a corporate action 3-to-1 split. So that might be the reason why there's such a big price gap there.
Why?
But no, we've got time. Well, let's go to TLG. Let's have a look at TLG.
Not at the moment. Look at this downtrend. It's still very much in place. Maybe it could form a base here, but it might not either. It could then continue down, break lower, and the downtrend could continue. So I don't want to punt on a base. You can punt on bases all the way down and keep getting stopped out, and ultimately you might get it right, but you might get stopped out a whole lot of times, and that can be emotionally pretty destabilizing. I'd rather wait, get the price above those moving averages, and then look at it then, not for now. And just ducking back to SMI, now we know what the situation is. And it would be, so look, assuming the share price is still up around where it is. So look, let's ignore that part for the moment, because the split wouldn't have changed the underlying structure of the price, because this will be adjusted at some point to reflect that. It's an uptrend, nice upward trend. It looks like it's consolidating back towards the moving averages. So if it was in my portfolio, I'd be holding.
All right, beautiful. I think that's it for another quality session. It's one of those things where we do this. We do this because we love it. We love analysing the markets. I love the comment there by Talwin there. Thanks for that. And it's one of those things that we do it for a passion more than anything else, isn't it, Jason? I know you've got a business in it, but this is also my passion in terms of being able to grow my wealth and investment, and hopefully being able to help others with doing that as well, as hopefully one day. All right. Other than that, anything else you want to sort of talk about, Jace, or we're sort of running good time today? 1:15.
Yeah, no, that's about it. And look, I just find it so interesting looking at the charts, looking at the structure, and just using these repeatable processes that we can apply to markets, whether it be stocks or indices or currencies, whatever it may be. Just getting a repeatable process where we don't know what the market's going to do next, but if we've got a process, we know what we're going to do in whatever situation. And so many people, they don't have a process. They're looking at that free online service, and they're reading a bit of that, and their mates are telling them something else. There's no process, and they're really, I think they've got no chance. It's only you find that the people who have success in this industry, in the investment and trading world, they're the ones with processes. It could be technical, it could be fundamental, but they can write down their approach, write down their rules, and you can see it's repeatable. And that's what I find fascinating, looking at the chart and looking at how we can use those repeatable rules to get ahead of the market.
Definitely, Jason. All right. I totally agree. And that's why we're here. That's why I'm here with you each week. Don't forget to like and subscribe, obviously, on our show, and write any comments you have. You can always reach me at Selfwealth, or you can reach Jason over at his fantastic service there at Motion Trader. We appreciate your time. Jason, I expect you next week to start growing your moustache just like mine, please.
I'll make a start on next year.
We'll talk about that next week, actually, because next week we won't be live because in Victoria it is obviously Melbourne Cup holiday on the Tuesday, which is public holiday. But we will have a pre-recorded show for you, which will go online at 12 o'clock on Tuesday, for the regular timing, right? So of it. But yeah, wishing everyone a great week ahead, and we'll see you live the week after.